Hello, welcome to Chapter 9's Introductory Problem. Chapter 9's Introductory Problem is exercise 9.8a. It's on page 509, and here it says Chapter 9 Introductory Problem Solution, and then it says exercise 9.8a, and it actually continues just all the way down to the bottom of the page. Now, it says to you the following transactions apply to Mid-South Equipment Sales Corporation for 2013, and we're going to be working primarily focusing on current liabilities. It has 10 events that are required to be that are given to us, and then it says show the effect. Requirement A is show the effect of these transactions on the financial statement with this horizontal analysis that we've done before. Then prepare the journal entries for those transactions. Prepare an income statement, balance sheet, statement of cash flow, and what is the total amount of liabilities then. So we're going to do a liability schedule at the end of these transactions. So now the way this requirement A analysis works is that we have the event over here in the far left-hand side. We have the assets in one column, liabilities in a column, equities, revenues, expenses, net income, and cash flow. So across the top here, we have those types of transactions. When we do this analysis, which this is one we've done since Chapter 1, we're saying whether these elements, these assets, liabilities, owner's equity, revenues, and expenses are going up or down. And then, of course, the way if they're going up, is that a debit or a credit? That's the next step in working with these. So you need to know what kind of an account it is, what element it represents, is it going up and down. So event 1 says the business was started when Mid-South received $60,000 from the issue of common stock. So I have $50,000, that's cash, so that's my assets, and they're going up as that shows right here. There are no liabilities. Equities are going up because I sold common stock. There's no revenues or expenses, and this is a financing activity in the cash flow. Event number 2 says purchase $60,000 of merchandise on account. So in number 2, merchandise is going up. It's an asset by $60,000, and it was on account, so a liability is going up by $160,000. There's no equity, no revenues, no expenses, and no net income and no cash flow, because we just got in inventory and did a credit purchase on account with that. Number 3, sold merchandise for $220,000 cash, not including sales tax. So I'm going to have cash going up here with this asset, that's a credit. I'm going to have the liability sales tax going up here. I'm going to have revenue going, sales tax is 8% if collected when the merchandise is sold. The merchandise had a cost of $40,000. So we have this A entry across here, and we have this B entry across here. So asset, cash going up, liability, sales tax payable going up, revenues going up, expenses going up, net income going up, and it's an operating activity here in the cash flow statement. The B part of that transaction is inventories going down, no change to the liability, and revenues are going down, and expenses are going up and net income is going down. So as I look at this transaction, on this part of it, I'm recognizing the cost of goods sold, the expense, and the recognition of the inventory going down. So I'm going to pull this up a bit and then look at number 4, provided a 6-month warranty on the merchandise sold. So I was giving a warranty. Now, based on industry estimates, the warranty claims to be 4% of the merchandise sales. So now I have nothing happening in the assets. I have this warranty payable going up, and I have this equity account going down, and then I have revenues going up, expenses going down, and nothing in the cash account. No effect in the cash flows. So we just do each one of these. Now, when we look at this, we think, okay, asset is going down, so I'd be representing that with a credit. Number 6, an asset going up, I'd be representing that with a debit. Number 7, we just began to look at these pluses and minuses in these transactions and try to figure out what the journal entries might be and what the effect on cash flow is. So I'm going to, financing activity is an FA, operating activity is an OA, and operating activity in number 9. So we have this analysis of these transactions in order to know what we expect to have happening. Now, when I get to these transactions, for number 1, started with received $60,000 in cash. So cash is an asset, it's going up. I'm going to debit that asset to increase it. Common stock is an equity account. It's going up because I sold more common stock, so I'm going to credit common stock to increase it. Both the debit and credit are for $60,000. Purchased $160,000 of merchandise on account. Now, I always say to you, stop and think about what kind of account that is. It's an account payable because somehow I have to pay for this merchandise I just bought. So I'm going to debit merchandise inventory. Whoops. I'm going to debit merchandise inventory, an asset that's going up. I'm going to credit accounts payable, a liability that's going up. Both of them are going up for $160,000. Now, on entry 3, sold merchandise for $220,000 cash, not including sales tax, which is 8%. So now what I'm going to have to do is I'm going to have to debit cash for 220 times 1.08. The 1 is for the 220 and the 08 is for the sales tax. So the sales tax here would be $17,060. So the cash is $237,600. Sales part of that is revenue, a credit going up of $220,000, and sales tax payable, a liability going up and increasing it with a credit. The B part is to recognize the change in inventory. So I'm going to debit cost of goods sold, the expense for the historical cost, $140,000, and it said merchandise had a cost of $140,000, and then merchandise inventory is going to be credited. It's an asset, it's coming down, so I'm going to credit merchandise inventory for $140,000. Now the next one says provided a 6-month warranty on the merchandise sold. Based on industry estimates, warranty claims would amount to 4% of merchandise sales. So if it's going to be 4% of merchandise sales, then the merchandise sales was $220,000. I'm going to take that up just a little bit more. $220,000 times 4% would be $8,800. Remember, I would multiply this by 0.04. And then warranties payable would be the liability that are going up, the obligation to honor those warranties if anything happens in the next 6 months. And so then that's $8,800. Number 5 says paid the sales tax to the state agency on the $180,000 sale. So I have sales tax payable, a liability that's going down because I don't have that liability anymore. And so that's 8% of $180,000 or $14,400. And credit cash, cash is the asset that's coming down by $14,400 because I'm sending that cash on to the sales tax agency. Number 6 says, on September 1, 2013, borrowed $40,000 from the local bank. The note had a 6% interest rate and matures in at March 2014. So I'm going to debit cash. Now this appears to be a note where the the interest is going to be added on, not discounted from the note. It would have said discounted the note if that were the case. So on September 1 they borrowed, so I'm going to debit cash because it's going up, and credit note payable because that obligation is going up, and both of them by $40,000. Number 7 says, paid $6,600 for warranty repairs during the year. So warranty payable is a liability that's going down because I don't have that obligation. I have fixed these products. So I debit the warranty payable, the liability for $6,600, and I credit cash for the amount of money I had to pay for the parts and labor to get these products repaired. And then 8 is paid operating expenses of $61,000 during the year. So I'm going to debit operating expenses for $61,000. I'm going to credit cash because cash is an asset and it's going down. So I'm going to credit it for $61,000. Number 9, paid $145,000 of accounts payable. So I'm going to debit accounts payable, $145,000. I'm going to, because that's a liability and it's going down, and I reduce a liability with a debit. And then paid is cash. That's an asset and it's going down. So I'm going to credit that asset cash to reduce it, and that was for $145,000. Recorded accrued interest at the end of the year. So now I'm going to pull this up here. I have a $40,000 loan at 6%, and it the loan was issued. It was borrowed for all of September, October, November, and December. So those 4 months, 4 of the 6 months were in this year. So it's going to be 4/12. So 40,000 times 0.06 times 4/12, and that would be $800. Remember, the interest rate is always stated per annum, so the time has to be stated per year. So now I'm going to be debiting interest expense to make it go up. See if I can pull that up just a little bit more for you. Debiting interest expense to make it go up by $800. Debiting interest payable, the obligation to pay this sometime in the future, for $800. So I've done the analysis, I've prepared the journal entries, and now I'm going to post them to the T accounts. So you've done a lot of this and you've worked with these T accounts. So here's the assets, here's the liability, here's the stockholders' equity, and you can see that these go down just in these columns, straight down, by the type of account that it is. So I didn't have any beginning balances because this was a new business. So I just post the transactions. And so here is cash for $60,000, and that's an entry 1. So I just come back up here, and here's $60,000, and it's a debit to cash. So I post that to the debit side of the cash account, and I identify it as transaction 1. And then here's common stock for $60,000. So that's going to be over in the owner's equity, and I put this entry 1 and $60,000 here in common stock. So right there. So I post all 10 of these transactions, posting them to the T accounts, numbering them as I go, and then prepare the income statement and balance sheet and cash flow statement. Well, the first step in doing that is to calculate the balances. So these are assets over here in the left-hand column. They all increase with debits, so they're going to have debit balances. So there's only 2 of them. So there's 2 of those with debit balances. And then here's the liabilities up here. And I see accounts payable, taxes payable, warranties payable, interest payable, notes payable, and that's all the liabilities that I'm using. So notice these all go up with credit, so they all have credit balances. So I'm going to go up to the top and show that to you. So here's accounts payable. Here's the credits, there's the debits. Subtract the difference and put it on the credit side because the credit number is bigger. And same thing with sales tax payable. The credit is bigger than the debit, and so the balance would be a credit. Same thing with warranties payable. The credit is bigger than the debit, so the balance would be a credit. Interest payable, there's only 1 transaction, so that's a credit. And notes payable, there's only 1 transaction, so it's a credit. So then the next set of accounts are the stockholders' equity, and then here's the common stock, and then here's the sales revenue, both of those, no other transactions there. The expense, cost of goods sold, only 1 entry there, so that's on the debit side. The operating expenses are on the debit side, and the warranties are on the debit side, and the interest expenses on the debit side. So I've calculated all of these balances. Now then the next thing it says is prepare financial statements. So here's an income statement, company name, name of the statement for the year ended and the date, and then here's sales, less cost of goods sold to get gross margin. And now here are the expenses, the operating expenses and the warranties to get the total expenses, the operating income, the interest expense, which is a non-operating item, because management chooses to do that. They don't have to borrow the money. They could use their own money. And then you get net income. And then here's the balance sheet, and the name of the company, the name of the statement, the date. Here are the assets. There are only 2, cash and merchandise inventory. And then the $ starts the column. So you have the cash and you have the merchandise inventory, comes straight out of these 2 T accounts, cash and merchandise inventory. So we'll come back and look at each of these T accounts, get these account balances from those T accounts and use them where they belong in the financial statements. So then here's the liabilities, and you've had accounts payable, but sales tax payable, warranties payable, interest payable, notes payable, total liabilities, those are all new for you this time after the accounts payable. And then here's the equity, the stock, and the retained earnings to get the total equity. Now you add these 2 these 2 totals, total liabilities and total equities, to get total equities and stockholders' equity, and that has to exactly equal the assets. So it's called a balance sheet because the assets equal the liabilities plus owner's equity right here. And then we have the cash flow statement. So we have the company name, the cash flow statement for the year ended, and we have cash flows from operating activities. And so we have inflows from customers and inflows from sales tax. So as we look down here for those 2 amounts, those would come straight from the T accounts. We could just go straight to the T accounts and find these two amounts where customers bought their goods for cash. And then we'd have outflows for inventory, outflows for expenses, and outflows for sales tax. Now, down here, notice that there are two expenses, and we add them together to get the 67. Now, you've been seeing these done at the bottom with these ones and twos like footnotes to this statement, and so that's a perfectly acceptable way to do it. You do put these numbers that are positive, the inflows as positive numbers, the outflows as negative numbers, and you get the difference as the net cash flows from operating activities. Now, the cash flows from investing activities, they didn't invest in anything. They didn't buy any assets. They might, land or building or cars or trucks, and they didn't pay a dividend to anybody. So they didn't do any of that. Here's the cash then from financing activities, and the inflow from cash stock issued and the inflow from the loan gives us two financing activities. They had $100,000 more money than they started out with because of debt and equity. So here's the debt in the $40,000, and here's the equity in the stock. So that means that there's a net change of $10,006 and $100,000 for $110,006. Zero in the beginning balance because it was brand new, but my goodness, there is the cash balance, $110,600, and when we check that, $110,600 right there in the cash account, $110,600. So as we look at those financial statements, they're simple and straightforward, and much simpler than what you're used to working with by far, but they are a nice general presentation of what these liabilities look like. The last question says, what's a schedule of current liabilities? So when I'm going to make up a schedule like that, I put whatever they're asking me to do at the top, current liabilities with a colon, and then I look at the T accounts or the trial balance, and I say, well, let's see, what do I have here? I have accounts payable, I have sales tax payable, I have warranties payable, now I have that interest payable, and I have that note. So let's come down here and let's see how we, there's the account payable, sales, warranties, interest, and notes, and I add those all together, and there's $62,500 in liabilities, and the balance sheet says that the liabilities are $62,500, so I have the right number. So when my purpose in giving you these sample problems is so that you can read a problem, see how to work a problem, look at the solution, look at what the solution, how the solution is presented by the authors, and then have an idea of how these solutions go together. So this is exercise 9.8a. It's on page 509, and it's primarily about current liabilities. So I hope it has helped you engage and embrace the ideas of liabilities, especially current liabilities, liabilities that will have to be paid in the next operating cycle, fiscal year, or calendar year. So welcome again to the world of liabilities.